Namaste. Welcome all of you again in Standard 12th Commerce. This is our sixth lecture in the online class series. Now let's start with the interesting thing again. In my last lecture, that is quiz of the day 5, I had given one quiz for you to solve. Okay, and the question was income. What is meant by income receivable? Okay, and I had given you the 4 options. Now let's see who has given the perfect answer. See, 5 students has given the perfect answer and all of them had given the correct answer. See, let's see. Option B was the correct answer. And who has given the first? Again, it's Harsh. Very good, very good. Again, Harsh has given the first answer. Very good, Harsh. Very good. Heartily congratulations to Harsh. I think it is the hat trick of Yash. Yash has given consecutive 3 times the correct answer. Very good, Yash. So you are the winner of this quiz. Very good. Very good, students. Very good, all of you students. Who are the other students? Other is Shravani Penkar, Miss Neugi, Miss Sakshi Belwalkar, and Aniket Valanju. All the students has given the correct answer. That is option B. Keep it on, students. Very good. Now let's move to our studies. You are learning bookkeeping and accountancy standard 12. Okay. Now we are on lesson number 1, that is introduction to partnership and partnership final accounts. So far we have completed what is the meaning, features, Indian Partnership Act, partnership deed, provisions applicable, and how to maintain the capital accounts of partners. We have already done these things. Okay. And you are now competent, means able to do all these things. Okay, to understand the meaning of the partnership, features, Indian Partnership Act, partnership deed, the provisions applicable in the absence of partnership deed, how to maintain capital accounts of partners. Okay, and understand the meaning of partnership final accounts. You have also known what is the need and importance of final accounts. Okay, now what you are going to learn today? So we are learning the effects of adjustments in final accounts. See, though you have learned how to maintain the capital accounts of partners and you have moved ahead towards the preparation of the final accounts, how to prepare the final accounts. But though you have completed this is the base for all. Okay, you don't have to forget it. You have to always remember this, because this, depending on this, you have to prepare the final accounts of the partners. Okay, we have done all these things. Okay, so we have learned 2 methods of capital account for the partners, right? And we have learned and done the practice of the same. But you have to remember this. Okay, you have to remember this. Okay, what we learnt in our last lecture? In our last lecture, we have seen some adjustments related to the final accounts. Okay, and the effects of the adjustments, which are from the page number 19. Now, today what we are going to see? We are going to learn remaining adjustments and their effects. See, adjustments and their effects. Okay, we are going to see today from page number 90 and 20. We are going to complete all the adjustments in detail. Okay, see, we have learned the different competency statements. Okay, and we are doing towards the making of the final accounts. Okay, preparation of the final accounts, and which steps comes under the final account? See, these are the 3 steps comes under the final accounts: trading account, profit and loss account, and balance sheet. Okay, trading account gives us the gross profit or gross loss. Whatever gross profit or gross loss, that is transferred to the profit and loss account, that is the second step. And we come to know either net profit or net loss from the profit and loss account, okay, during the financial year. And third step in the financial statements is balance sheet, okay. So balance sheet is a statement, okay, it is not account, which shows the financial position or financial status of the firm on a particular day in the form of assets and liabilities, okay. We have seen all these three things, okay. Now you have to also remember whatever you have learnt in standard 11, okay, in final accountancy account of proprietary concern. That is again the base, and whatever we learnt in topic number 1 this year, that is partnership final accounts, preparation of the different two methods, okay, of preparation of the capital account and current account, okay, and as per fixed method and as per fluctuating method, okay. This also you have to remember, and you have to refer, you will be required to refer your book of standard 11. Every adjustment must have, but basically you have to remember these two rules. Every adjustment must have two effects. Every adjustment, okay, which is given below the trial balance for you in the question. Adjustment means what? The adjustment is the one which is given below the trial balance for you to solve in the question. Every adjustment has two effects, okay, in the final accounts. One is debit effect and another is credit effect, okay. Now we are going to see the different adjustments in final accounts. Which are the most common types of adjustment entries? Those are accrued revenues, unearned revenues, depreciation, prepaid expenses, accrued expenses, okay. But the basic thing is what to do, when to debit and when to credit an account. See, whenever we have to solve the problems of final accounts, we don't know the accounting journal. We don't know which debit means debit assets account, expenses account, and credit liability account, owner's equity and revenue account. Okay, but we don't know. We don't understand generally when to debit and when to credit an account. So for that, we are going to learn in depth. In my last lecture, consider here by particular income, okay, by particular income example commission, and by particular income example salary. Now let's move towards today's lecture. In our last lecture, we had ended with adjustment number 6, that was of bad debts. Okay, what is meant by bad debts? Bad debts are the irrecoverable debts. The debts, okay, debts means what? The dues from the debtors which are irrecoverable. Dues from the debtors which are irrecoverable are called as bad debts. The amount of bad debts is basically a loss to the business. So it is debited to the profit and loss account and deducted from the sundry debtors from the asset side. Why? Because those are irrecoverable. Okay. Now, with reference to the bad debts, which we learnt in our last lecture, we will move ahead. Okay. Understood what is meant by doubtful debts? Okay. Now the next adjustment is adjustment number 7. See, it is provision for doubtful debts or reserve for doubtful debts or new reserve for doubtful debts. What it is and how to make its effect? Its first effect is to show the on the debit side of the profit and loss account. Okay, profit and loss account debit side as two bad debts. old plus add new, because they have told about new. If it is new given, then new, add new bad debts or provision for the provision or reserve for doubtful debts, and make the total of this and take the final total to the outer side. Okay. See, there are some debtors of which recovery is doubtful. Out of the debtors, some debtors are doubtful, whose recovery is doubtful. It may not be realized. May not be realized means may not be converted into cash, or we may not get its money. For this purpose, such provision is created which is known as reserve for doubtful debts. Reserve for doubtful debts, which are whose recovery is doubtful. This provision is created on the experience of previous year. How do we come to know that these are doubtful debts? Because of the experiences of the earlier years. It is an anticipated loss. With that, we consider that it is a loss. Therefore, provision for doubtful debts is necessary. We have to provide. We have to make a provision that we may not get this. It is very doubtful to receive these debts, right? So, we have to, as it is a loss, we have to add to the profit and loss account debit side. If new reserve given, then we have to add it to the old bad debts. Okay. And what is its second effect? See, as it is a loss, so we have to deduct it from the sundry debtors because it's a provision. Okay, so we have to deduct the provision or reserve for doubtful debts from the sundry debtors, and the final amount of debtors we will get over here. Okay, this is the entry or effect for the provision for doubtful debts. The next is reserve for discount on debtors. See, this is something different. Reserve. Okay. See, what is meant by this? It is an incentive to the debtors for early payment. It is an incentive. Okay. Benefit for the debtors for their early payment. Okay. Such discount is also treated as loss. Okay. Why? We are giving it as a benefit to the debtors. So it is loss for us. This discount is calculated on the amount of debtors after deducting new bad debts and new RDD. We'll see how to do it. Okay, first of all we'll see reserve for discount on debtors, which is given for their early payment. Okay, incentive for their early payment against their debts, and it is treated as loss. First effect, show to the debit side of profit and loss account, that is add to the discount allowed. Profit and loss account debit side to reserve or provision for discount on debtors. Discount on debtors. And what is its second effect? Because it is a loss. Okay. What is the second effect? Deduct from the sundry debtors. Okay. From the balance sheet asset side. But how to deduct it? This discount is calculated. How to calculate this discount? Because this is a discount for their early payment. Okay. How to calculate a discount? See, there are some rules. This discount is calculated on the amount of debtors. But how? After deducting new bad debts and new RDD. Okay. So first of all, we have to deduct bad debts. Okay, we have to deduct the bad debts first, new bad debts first, then we will get some amount. Okay, then we have to deduct new reserve for doubtful debts, then we will get some another amount. Okay, and then we have to provide for the discount on debtors. Okay, this discount is not given to the debtors directly. Okay, this discount is not calculated directly. After deducting the new bad debts, then again after deducting the reserve for doubtful debts, we have to make provision for discount on debtors. Okay, so we'll get this amount, that is discount for debtors. This same amount we have to write over here. Okay, discount for reserve or provision for discount on debtors. Okay, this is an important adjustment that we have to remember. It is an important adjustment. Okay, important adjustment which you have to remember. Next is depreciation. What is meant by depreciation? Depreciation means gradual and continuous decrease on reduction in the value of assets, right? The value of the assets decreases gradually and continuously. Okay, this amount of depreciation is charged on fixed asset. It is treated as loss. So it is to be debited to the profit and loss account and to be deducted from respective asset, because the value of the assets gets reduced, right? Because of the depreciation, the value of the asset gets reduced. Okay, and we get the reduced value. So we have to reduce it also. Okay, so what is the effect of depreciation? Show on the debit side of the profit and loss account. Very simple. Profit and loss account to depreciation, debit side. And the second effect is less from the particular asset in balance sheet asset side to particular fixed asset, example machinery in the balance sheet, less its depreciation. It may be given in percentage. Okay, either it may be given in percentage or in value. Okay, so you have to depreciate that amount, and this would be the final amount of the asset after making the depreciation. This depreciation value you have to write over here. Okay, this depreciation amount you have to write over here. You have already learned this in standard 11th. Next is C. For adjustment number 10, there are 3 entries. First of all, it is interest on capital. C. Who brings the capital? Partner. Here partners brings the capital to start or commence the business. Okay, so the partnership firm has to give them the interest, right? They brings in the capital to run the business, right? So capital is basically a liability. Capital is itself a liability. Again, the firm has to pay interest to the partners. Firms has to pay interest to the partners on the capital they have brought. Okay, on the capital they have brought. So again, it is a liability for the firm. For the partnership firm, it is a liability. Capital itself a liability, and to pay interest on their capital, again it is a liability, add-on liability, top-up liability, right? So it is a liability. What is the effect of this liability? See, show to the debit side of profit and loss account. Very simple. To interest on capital, profit and loss account debit side. But for partners capital or current account, credit side, or add to the capital or current account. Let's see what does this mean. See, what we have to pay interest on capital. See, in topic 1 in this lesson, we have learned how to maintain the capital accounts. Methods. We have learned 2 methods, fluctuating capital method and fixed capital method, right? Now, if interest on capital is to be given to the partners, if we follow 2 methods, okay, as per the first method, fluctuating capital method. In fluctuating capital method, what is done? All the transactions are recorded in a same account, right? In fluctuating capital method, all the transactions regarding partners, everything are recorded in only one account, that is partners capital account. Okay, so after writing their balances, capital balances, we will write by interest on capital. By interest on capital to the both partners or whoever are the partners. This is partner X amount, interest on capital, Y's amount, interest on capital. As per fluctuating capital account. Okay. In partners capital, after capital, we will write there. This is capital amount. This is capital amount, right? And after capital amount, we will write the interest on capital. Okay, but as per fixed capital method, we have to maintain partners capital account, and in partners capital account nothing apart from the capital is mentioned, right? Nothing apart from their capital, any other entry is recorded. So for the interest on capital, we cannot record it in the partners capital account. For that we need to open another account, that is partners current account, right? If you remember, we learnt in first lecture, we need to maintain another account, that is partners current account, okay, for the other transactions. Okay, so in partners current account, after their credit balance, if it is written, second entry would be by interest on capital. Okay, in different partners names, right? Against different partners names. So you have to remember this very well forever. For interest on capital, we have to maintain it in two ways. Okay, whatever method the company is, that specific firm is following, if it is following fluctuating capital method, then you have to do this. If it is following fixed capital method, then you have to write in partners current account. What you have to write? Interest on capital. The transaction you have to record like this: interest on capital. Okay, you have to see which method they are following. See, but I have already told you, if it is not clearly mentioned which method they are following, then you have to follow the fluctuating capital method only. Okay, unless and until it is specifically mentioned, you have to follow fluctuating capital method only. Okay, if it is mentioned that the firm is following fixed capital method, then you have to make its entry under partners current account. Okay, so what it is written: partners capital or current account credit side, or add to the capitals or current account, add it. Okay, the next entry, that is interest on drawings, right? See, it is the income to the business, hence to be added in the statement of profit or loss. It is what? There are two entries. Okay, I have shown this entry on this page. Okay, it is the income to the business, hence to be added in the statement of profit and loss account. It is in income, so profit and loss account by interest on drawings. Okay, and what is its second effect? See, show to the debit side of the partners, show to the credit side of the profit and loss account that we have done. Show to the debit side of partners capital or current account. Debit side of partners capital or current account, or less from the capital or current account. See, again it is something different which you have to remember properly. Okay, see, show to the debit side of partners capital or current account, or less from capital or current account. Now we'll see it properly. See, if that business is maintaining fluctuating capital method, that business is following fluctuating capital method, then as per fluctuating capital method, everything is recorded in partners capital account only. Remember, as per fluctuating capital method, everything is recorded in partners capital account only. Okay, or if the business is following fixed capital method, then everything is recorded in partners current account. What is everything? Apart from the capital, main capital and main withdrawals. Apart from the main capital and main withdrawal, everything is recorded in partners current account only. Now, interest on drawings. Okay, as per fluctuating method, how we will write? After drawings, we will write to interest on drawings. As per fluctuating capital method, we will make it debit. Okay, to partners capital account as per fluctuating capital method to interest on drawings. Okay, and against the names of the partners, we will write the amount of interest on drawings, right? That the percentage for interest are given in the question itself. Okay, as per fixed capital method under partner's current account. Okay, you have to write to interest on drawing after the drawings. But if the company is following fluctuating capital method, okay, then in partner's capital account, instead of doing this, okay, writing it on the debit side, you can deduct it from the credit side also. See, or less from the capital or current account. Okay, you can deduct it also. That is, this is by balance brought down, that is the credit balance. What it is? Capital balance, right? It is capital balance, and from this capital balance you can deduct this interest on drawing. Okay, or less from the capital or current account against the names of the two partners. Next, interest on loan taken. See what it is. What is interest on loan taken? See, who has taken the loan? Partners has taken the loan. Okay, so they have to pay the loan, right? They have to pay the loan. Partners has taken the loan and they have to pay the loan. Okay, now apart from this loan, they have to pay again the interest also. They have to pay the interest also. So they have to pay loan as well as interest. Okay, so this is a liability as well as, both of the things are liability, but this interest is a expenditure, right? For that specific year, that is an expenditure. Okay, so the same kind of example we had seen, interest on drawings, right? Drawings and interest on drawings, again capital and interest on capital. Similarly, capital and interest on capital is the same as this. Okay, now expenditure, interest on loan taken is expenditure as well as liability. Now see, what is its first effect? Show to the debit side of profit and loss account, because it is an expenditure. Profit and loss account debit side to interest on loan taken. Okay, for whatever loan has been taken by the partners, you have to pay the interest. To interest on loan taken, whatever is the amount, you have to write it. And what is its second effect? Add to the loan taken in the balance sheet liability side. Okay, in the balance sheet liability side, you have to write the loan from whatever bank, okay, secured or unsecured loan, that you have to write loan. Then you have to add its interest also, loan plus add interest on loan, because that interest on loan is for that specific year you are paying. So this is your total liability. Loan is also your liability and interest on loan is also your liability. So this will be your total liability. Okay, this again a different thing and you have to remember it. Next is interest on investment and loan given. See, here it is given. Interest on investment on loan given. Okay, see what it is. It is an income and asset. Why? We have given the loan. Okay, so somebody is due. Somebody is due to pay us, repay us. Okay, so for the time being, it is an asset for us. For the time being, whom we have given the loan, he has to pay us. So it is an asset, and he has to pay us the interest also on that loan. Okay, so that is an income for us. Now let's see how to do its effects. Its first effect is show to the credit side of the profit and loss account. Profit and loss account credit side by interest on investment on loan given. Interest on investment or loan. Interest on investment or loan. Okay, investment on loan. Okay, this is an income for that specific year, and it is an asset also. Interest on investment and loan for the given loan, it is an asset also. Okay, because that specific person whom we have given the loan. Okay, so he has to pay us that loan and he has to pay the interest also. Now let's see. See, our next adjustments are regarding goods. See, what does this picture depict? There is a fire in the factory. Okay, there is a fire. This is a factory and there is a fire. And some goods seems to be insured. See, this is a fire and some goods seem to be insured. That's why the owner is happy. Happy or you can say relaxed. Okay, the owner seems to be comparatively relaxed because he has an insurance against the fire, against the goods which have been caught in the fire. Okay, and this is a factory. Now let's see. See, our 12th adjustment is regarding insured goods destroyed by fire or accident. Insured, the goods has been insured. Which goods has been insured? Which has been destroyed by fire or accident. Okay, insured. See, if the goods are insured, listen properly. If the goods are insured, then we have to make 3 entries. Okay, first of all, we have to show in the trading account the actual amount of the goods. Okay, the gross amount of the goods which were destroyed by fire. The gross amount of the goods. Okay, remember this is the first entry. The gross amount of the goods which are destroyed by the fire, that amount we have to write in the trading account. Okay, this is a trading account. See, this is a trading account. Okay, and in trading account we have to write the gross amount. We have to write the gross amount of the goods which were destroyed by fire. This is the first entry. Okay, and second entry is in profit and loss account. See, this is the profit and loss account, the bottom part of the trading account. Below trading account we write the profit and loss account. See, what we have to write, which amount we have to write. See, here I have written X. Okay, but in profit and loss account, what is our actual loss? What is our goods are insured? Here we are taking the example of insured goods. Okay, see, this is adjustment number 12 and first part. Adjustment number 12, first part. The goods destroyed by fire or accident but which are insured. Okay, in terms of insured goods, in trading account we have to write the gross amount of the goods which got destroyed by fire. Okay, and in profit and loss account we have to write the actual loss amount. Okay, in profit and loss account we have to write the actual loss amount. What is meant by actual loss amount? See, this actual loss amount is something different. Okay, this actual loss amount is something different. What does this mean? See, here the goods are insured. For example, the goods of the amount of rupees 8,000 caught in fire. Okay, listen properly. Goods of the amount of rupees 8,000 caught in fire. Okay, amount of rupees 8,000 caught in fire. Okay, and because the goods are insured, so what is the insurance claim? Insurance claim is rupees 6,000. Okay, insurance company is ready to pay. Insurance company has done the audit. Okay, insurance company visited your factory and done the audit and pay you rupees 6,000. So the claim they have accepted is of rupees 6,000. Okay, because your goods are insured. Okay, your total goods were of rupees 8,000. Your goods were of rupees 8,000. Out of that, okay, the total goods which caught fire. Okay, goods which caught fire were of rupees 8,000. Insurance company is ready to pay the claim of rupees 6,000. Okay, so what is your actual loss? Your actual loss is rupees 2,000. This 2,000 is your loss only. Okay, 2,000 rupees is your loss. Okay, so whatever you are lost, that is the Y amount that you have to write to the debit side of profit and loss account. Okay, goods destroyed by fire, its amount of loss you have to write to the debit side of profit and loss account. Remember properly. Okay, and what is the second effect? See, balance sheet asset side claim amount. Balance sheet asset side only claim amount. What is your claim amount? 6,000. Okay, 6,000 your claim amount that you have to write to the balance sheet asset side, because you are going to get rupees 6,000. Okay, out of these 8,000, this 8,000 you have to show as a stock. Out of that, this 8,000 you are about, you can get the claim of rupees 6,000, and 2,000 is your total loss. Okay, that cannot be compensated, that cannot be recovered. This loss, because it is a loss, properly a loss, which cannot be recovered. Okay, 6,000 rupees can be recovered out of the amount which got fired. Okay, see, balance sheet asset side claim amount you have to write. This is insurance claim. Okay, insurance claim, how do we calculate? This x-axis minus y. Okay, this x-axis minus y is the insurance claim. Okay, insurance claim is x-axis minus y, that is amount z. And what you have to write? Second entry is profit and loss account debit side amount of loss. Okay, remember this is again an important entry. This is again an important entry. Okay, important entry. Next, see, now the factory caught fire. Okay, your factory caught fire and everything got wasted. Everything got wasted. Nothing got saved, and nothing was insured also. None of the material, none of the goods from your factory were insured. Okay, nothing was insured, all were uninsured. Okay, uninsured. Uninsured means not insured. Okay, though the fire brigade came, but all of the material was uninsured. Okay, then in this case what happens? See, uninsured goods destroyed by fire. Okay, uninsured, there was no any insurance claim, there was no any insurance against the goods. Okay, now in this case it is simple. All of the goods, see here, the amount in trading account, that is gross amount, and the amount in profit and loss account is the same. Why? As the goods are uninsured, that is not insured. So the entire amount of good destroyed or lost is a loss only. Wait, I will tell you. See, uninsured, there was not an insurance against the goods. There was not any insurance. You hadn't taken any insurance for the goods in your factory which got by fire. Okay. Now in this case, what we have to do? See, everything whatever you lost cannot be compensated. You cannot get any money against the amount which you lost in the fire, right? So entire amount which you lost is an loss, is a loss. Okay, because you hadn't insured anything, your goods were uninsured. So for this, first entry is profit and loss account debit side. Profit and loss account debit side. Okay, to goods destroyed, loss by fire, whatever amount it is. And actually this is the first entry. Show to the credit side of trading account, by goods destroyed by fire, its gross amount, whatever was the amount of the goods which got destroyed by fire, you have to write its amount. At the same amount will come as a as a loss to the good destroyed as loss by fire, to the debit side of profit and loss account. See, this is a trading account and this is a profit and loss account. Here it is the same. Why? Because the goods were uninsured. There is no any claim. You are not getting some part or some recovery of the goods which you lost, right? Because you don't have the claim, you don't have the insurance claim. Okay, because you don't have the insurance claim, all of the amount what you lost, all is your loss, all that amount is loss. Okay, so Good destroyed by fire, its gross amount will come over here to the trading account, and the same amount will come as a loss to the profit and loss account. Okay, goods destroyed by loss by fire. Okay, we will see its example in illustration number 10. Now see, what is this? See, there is a robbery. There is a robbery in your factory. Okay, they have stolen the goods. They have robbed the factory and they have stolen the goods. Who? They means who? Thieves. Thieves have stolen the goods, right? Now, what is the entry for the goods stolen? See, it is again a loss. Simple. Show to the credit side of trading account. Trading account, buy goods lost by fire, trading account. Okay, the amount which you have to show, and profit and loss account, debit side. To the goods lost by theft, right? Profit and loss account, debit side. Okay, profit and loss account, debit side, and trading account, credit side. See, if the goods are pilfered or lost by theft or stolen, then it becomes physical loss of goods. Okay, it is a physical loss of goods. We will see its example in practical problem number 1. Okay, in your book for the practical problem, not the illustrations. Okay, this has not been solved. We have to solve it, right? This example has been given. What is this? See, people are carrying something, right? Some people, there is something in the hands of the people. They are carrying something that may be gift, right? This gift may be given by the owner, by the partners. Okay, this can be as an advertisement, right? Let's see what it is. See, it is goods distributed as free samples. Goods distributed as free samples. See, it is an expenses. What does this mean? Distribution of goods as a free sample, right, is an advertisement. Why company or partners or a firm distribute the goods for as a free sample? Because it is an advertisement. For what? Consider as an expenses incurred for the promotion of goods. See, if they are promoting the goods, if they are new in the that business of that or that specific goods, then for the promotion of the goods, right, for the promotion they can make the advertisement. For the advertisement purpose they can give the free samples, right? So they can distribute the goods as a free sample, as an advertisement. For what? As a promotion of the goods. So it is an expense for the business, for the company. So what are its effects? Show to the credit side of the trading account. Buy goods distributed as free samples. Okay, because you have to show it how much was the stock which you distributed as free sample. Okay, that you have to show over here. Okay, that buy goods distributed as free sample, whatever is the amount of the goods, and to the profit and loss account. This is profit and loss account. You have to show it as advertisement expenses. That goods distributed as free sample, the same amount. Okay, the same amount, because this is an expense. Okay, so you have to show in trading account also, in credit side, and profit and loss account, debit side. See, this was the trading account and this is the profit and loss account. Okay, we will see the example of this type, good distributed as sample, in illustration number 9. Okay, and in practical problems 5 and 7. So three examples, okay, three sums we will get the example of this type. What? Of this adjustment. What is the adjustments? Good distributed as free sample. Okay. So what is the quiz of this day? Where the actual loss, where the actual loss amount of good destroyed by fire, is recorded in final accounts. Actual loss amount of goods destroyed by fire is recorded in final accounts. See, there are four options. Either it is debited to trading account, either it is credited to trading account, or it is debited to profit and loss account, or adjusted under asset side in liabilities. In asset side in balance sheet. Okay, asset side in balance sheet. Okay, asset side in balance sheet. See, so you have to give the answer, perfect answer, correct answer immediately. Let's see who is the winner of this quiz of the day 6. What we'll see in our next lecture? In our next lecture, we'll see the remaining adjustment from page number 20 to 23. Adjustments means what? See, this picture itself depicts what is meant by adjustment. Adjustments has their effects. See, what is meant by effect? Adjustments has their effects. We can come to know by this. Okay. So adjustment and their effects on final accounts, which are given on your page number 20 to 23. We'll see in the next lecture, remaining adjustments. Okay. Till then you have to read